Welcome to my channel, The Graducator. In this video, we're delving into the intricate world of banking, but don't worry, it won't be dry and boring. I'll try and make sure of that. Before we dive in, do me a solid, give that like button a tap and hit subscribe below. By doing so, you're not just supporting the channel, you're also ensuring you never miss out on more enlightening Graducator content in the future. Now, let's talk about something you've probably encountered but might not fully understand. Bank loans for companies. Ever wondered why so many businesses turn to loans? It's not always because they're short on funds. In fact, it's often a strategic move to manage their finances more effectively. By securing a loan for day-to-day expenses or significant investments like equipment or property, companies can keep their own capital free for more strategic endeavors. It's all about financial maneuvering. Now, let's get into the details. These loans can range from a few million to billions of dollars. But here's the catch. No single bank typically bears all that risk alone. Instead, it's spread across multiple banks through what we call club deals or syndicates. Yes, I know the terms can sound a bit fancy. Let's get straight into club deals. These tend to be good for mid to large size loans and typically involve just a couple of banks. The borrower will usually have a separate relationship with each bank, and this can mean the deal can be a lot more tailored as there will be separate legal agreements. Now, syndicate loans are for the big loans. Think billions with a few lead banks coordinating the deal and bringing in more players, usually for a nice little fee. There is also one extensive legal agreement that all banks will refer to, and so due to the complexity of this process, it can take much longer to arrange than a club deal. Syndicate loans can also be traded on the secondary market because of how they are structured. Quick recap time. We've got bilateral deals, which are your bog standard one-on-one loans. Club deals are a small gathering of banks for loans, usually less than $150 million in size, and with each bank individually having a strong relationship with the borrower. Whereas syndicates involve few lead banks coordinating a standardized deal where they bring in other banks. For both clubs and syndicates, banks can share the loan in equal or unequal portions, and the highest lenders are referred to as Tier 1. The more a bank lends, the more perks it receives, like ancillary business and cross-selling opportunities. So that sums up corporate loans in a nutshell. But hold on, there's more. In my next videos, we'll be exploring how exactly banks are set up and how corporate banking works. Stay tuned, be sure to subscribe.